Hello and welcome everyone. My name is Philip Marion. I'm the Managing Director of the Foster Family Office. In my previous interviews, we discussed real estate debt and private equity, but today we'll be discussing private credit. With me today is Colin Kilgour, who is the co-founder and principal of Kilgour Williams. Thank you for joining, Colin.
My pleasure.
I'll
Happy to
start
be
off
here.
with an easy question. Just tell us about Kilgour Williams, why you founded the firm, and what type of strategies you do.
Sure. I mean, the obvious one is like most entrepreneurs, I needed a job. So I had been in the credit space prior to the financial crisis. I had sold my business and exited, and was in the process of launching a new business in the wholesale finance space. I joined up with a firm called Connor Clark and Line, who some of you may be familiar with, to launch a new venture there. That was the summer of 2007 when the credit markets were disrupted. In Canada, that was embodied in the asset-backed commercial paper meltdown. A byproduct of that was it blew up my business plan on the launch pad. So I ended up parting ways with Connor Clark and Line and began an advisory business, which ultimately became Kilgour Williams Capital today. Back then, we were focused on helping investors who had got stuck with paper in the asset-backed commercial paper meltdown in 2007. We actually were involved in that for about 10 years. So most of it was in the headlines for a couple of years when there was a restructuring. But then for the investors who were lucky enough to hold the paper, they were reissued long-term notes that didn't mature until 2017. So in 2009, when my partner Dan Williams joined me, we worked together to support investors right through to 2017, when most of the paper matured, and advising, managing, trading, litigating, regulating that paper. And that was a very niche business for us that had a natural conclusion in 2017. At that point, we pivoted to become an investment management firm. We'd seen a lot of good and bad about the credit world in the preceding 10 years of dealing with structured credit and the detritus that was the ABCP meltdown. And we said we need to raise some investor capital. We want to do things right. And so we took everything that we learned and didn't like about asset-backed commercial paper and found a strategy that is almost the antithesis of that. So we're investing in private credit, actual loans, nothing that has a three-letter acronym attached to it. So it's actual loans to actual businesses and individuals. There's no synthetic leverage or derivatives or opaque instruments that you can't understand. We're doing loans. Pretty much everyone can understand what a loan is. You lend out some money, you hope to get it back, and you hope to get your interest. And that's kind of what we do. And that, to us, after 10 years of being in the mud of structured credit and the biggest CCAA filing in Canadian history, was a breath of fresh air for us. And so we gravitated to the particular private credit strategy that we've embarked upon in 2017.
So you have, let's go into the investment strategies in a bit more detail. So you have an option for a private credit fund and also a standalone option to be more directly invested in business credit. So can you discuss that in a bit more detail? What are the buckets? Where are you lending?
Sure. Our flagship fund, the fund we first launched in 2017, so we've been managing it for a little over 6 years now, is Kiwi Private Credit Fund, and it invests in three types of credit. Common to all of them is they relatively small balance loans, and which enables us to have a very diversified portfolio. But the lending verticals are prime consumer loans, so typically individuals who are seeking to consolidate their credit card debt. We invest in small business loans, which you already mentioned, and these would be businesses on any main street in any town in any country in the world, although we tend to be in the United States. And we do first mortgage loans to residential developers, and the particular type of lending we do there are to developers who are rehabilitating properties. So colloquially, we would call it fix and flip. So you're going to buy a property, you're going to add some value to it through a project, and then at the end of the project, you either sell the property or maybe you turn it into a revenue property, and you get conventional financing as opposed to the financing which we provide, which tends to be a little bit more expensive. So that's the flagship strategy, and that gives you a mix of 3 different types of credit. It gives you massive diversification. It gives you access to all different types of geographies across. We're mostly in the United States, so we're in every state in the United States. So it gives you all kinds of diversification, and it's a very kind of conservative, middle of the road strategy that's designed to yield kind of 7 to 8%. Right? It's a let's keep it on the fairway and try and par it out, if you want to use a golf metaphor.
Right.
So that was working very well for us and continues to work well for us. A couple of years later, and each of those asset classes has a different risk return profile. So the consumer portfolio tends to be very stable but lower yielding. The real estate portfolio is a little bit higher yielding, and then even higher than that is the business portfolio, but potentially open to slightly greater volatility. So that's the trade-off. I mean, you put all these together, you're looking for stability and that predictable return. And that's largely what has happened over the last 6 years. Then about 2 years ago, 2.5 years ago, we were talking to investors. It could have been one of your competitors or colleagues, and said, we like your guys' approach to credit investing. What we don't like is that you're 7 to 8 yield. There are investors out there who have higher yield aspirations for their credit investments, and they're looking for something that has a double-digit handle on it. So we said, well, we actually have that in our business portfolio. Our business portfolio consistently yields low to mid-teens, net of everything, net of losses, net of fees and expenses and all that stuff. It consistently is a double-digit performer, but it's always been baked within our flagship fund. So we said, why don't we take that and put it in its own vehicle? And the flagship fund will still continue to invest in it because it likes the diversification of having the 3 asset classes, but we'll create a new fund. And for those investors that are looking for that double-digit return, we can make that direct available to them. So we did that in the summer of 2021. That's called the Kiwi Business Credit Fund. It's been running for a little over 2 years now. It has continued to perform very well, although now it has its own auditable results, whereas it used to be within Kiwi Private Credit Fund. And just last month, we were awarded with the Canadian Hedge Fund Award first place for 1-year return. So the fund has been performing well, and we're starting to get some recognition for it. So we're grateful for that.
How do you? So between the 3 sort of lending verticals, how many loans do you have, and how do you manage that many? Like, what's the typical loan?
Well, this is really where it gets interesting, and one of the reasons we chose this strategy. So thank you for the question. So we have about 6,000 loans in the portfolio, and that's a lot. Okay, you say, well, how do you manage? How does as a boutique investment manager in downtown Toronto manage 6,000 individual loans, which are largely in the United States, and about 95% of them would be in the United States? We work with fintech partners and to access these loans, and fintech is really what has enabled this asset class. And for some of the people listening, back in the day, it would have been called, and back in the day, I mean like 10 years ago, would have been called peer-to-peer lending, where you're investing in loans over the internet. Companies like Lending Club and Prosper started this up. Then it evolved into a term called marketplace lending, where you'd have these online lenders that are originating, underwriting, and servicing loans. So doing kind of all the operational things that you would think a bank or traditional lender would do. But what these marketplace lenders don't have is they don't have balance sheet. So what they do is they make the loans available on a marketplace to institutional investors like us, and in some cases to retail investors as well. So we would be able to work with a number of these fintech lenders, and after having diligenced them and got comfortable with their processes and their underwriting, we can specify criteria to them of loans that we'd like to put in our portfolio. And when they have those loans available, they make them available to us in an electronic way. We see all the information we need to see about the loans, whether it's, it depends on the type of loan, the type of the information we get, but we get a very fulsome underwriting file, and we can make a decision as to whether we want to add this to our portfolio or not. If we add it to our portfolio, we provide the capital, so we are funding the loan. The borrower gets the money, and we take all the credit risk, and we get all the return for the credit risk. So it's something that really plays into our comfort zone, because we are credit guys. We are comfortable taking credit risk. We're comfortable pricing credit risk, and we enjoy the return that it provides our investors. From the fintech's perspective, they say, well, why would they do this? And why don't they just get some money and lend it out themselves? Well, there are some that do that, but their business model is a little bit different. They earn a fee from originating the loan, so they get paid by the borrowers, which is typical in pretty much any type of borrowing, whether it's from consumer lending up to investment grade bond issuers. They all pay the underwriter who places the paper. So the fintechs get a fee from the borrower, and they also get paid by us. So we pay them for doing the servicing. And when I say servicing, I mean the collections. So most of the collections come by a pre-authorized debit and are very simple. But when things go delinquent, or when if something were to go into default, there's phone calls, there's emails, right up to and including legal processes, foreclosures, selling properties, things like that. So it's a full soup to nuts servicing that they provide, and we pay them for that. And that's their business model. And what that allows them to do is get a lot of leverage out of their capital, because they don't have to have funds like we do. And they get valued as a growth company, they get valued as a tech company rather than as a bank. So it's a model that works for them. It's a model that works for us because it's not our strength. Our strength is credit management. And what fintech does, and again, this could not have been done 10 years ago. What fintech does is it opens up attractive asset classes to us as investors where previously we wouldn't have been able to. So small business credit's been around forever, and consumer finance has been around forever. But back in the day, if you wanted to get access to that as an asset class, you really had to start up a business and open your own lending shop. And you'd have a storefront, and you'd have a bag of money, and you'd lend it out to to people in your area who are creditworthy. This takes that to a whole nother level. It allows us to be investors rather than lenders, and it allows us to build a portfolio all across the United States rather than just whoever walks into my storefront on Front Street.
So this leads into my next question, which is valuation. How are you valuing these loans? You've got so many. Which is it different for each bucket? And you can go over those details.
Excellent and important question, especially given what we've seen in private credit in Canada over the last few years. Valuation is key in private assets, whether it's equity, credit, whatever, anything private. There's always that question the investors have is, how do I know how you're marking the book, and how do I know that valuation is true, and all that kind of stuff. So we understand that, and so from day one, and we understand that question as we got into this. So from day one, we said we're going to do the following. We're going to have a monthly valuation, because we're evergreen funds. So investors can come in each month, they can redeem each month. So if that's happening, you need to know precisely what your NAV is at every point in time, so that you're treating investors fairly. So with that as a commitment, we needed to make sure we're valuing the fund every month, and we needed an external valuation agent. So we engaged an external valuation agent, which is an analytics firm out of San Francisco who specializes in the space, who has developed a statistical model based on actual historical data in the relevant asset classes. And they will literally put a price on every one of our 6,000 loans in the portfolio every single month. And the general principle, without going to the full stats of it, is a current loan, so one that makes payments every single month, will get valued at par. Anything which is a single day delinquent or more will suffer some negative mark or loss expectation against it. So if you think of a consumer loan, the guy misses the payment, he's 3 days late, that probably will have a 10 to 15% markdown on it immediately. And then it progresses every month. If the guy doesn't come current and make the loan back to current, it'll suffer significantly progressively more severe write-downs, until such point, if it goes into default, it will already be marked down to its expected recovery value. So there's no shock to the investors. What that means is that when you buy into the portfolio, or you buy into the fund, you're buying in at a NAV which has been independently verified on the day you invest, And so you're not buying into someone else's problems. And you also know that on the day you redeem, you're not leaving your problems behind. If there's delinquency in the portfolio, that's going to be reflected in the valuation when you redeem. It's very fair to investors, and quite frankly, something which I think differentiates us in the Canadian context, because we've seen a lot of private credit managers who mark their own book and say things like, well, it's too complicated to get an external manager, or it's too much hassle to do that, or I know this guy's good for the loans, so I'm just going to mark them all at par, or I've got asset coverage. I've heard all the stories, and then something blows up and it's in the press, and we say, well, why didn't the auditors catch that? So we're trying to get out in front of that. I think we've done a good job of it.
Can we go back to the business credit fund? I just want to get an idea of the typical borrower. You mentioned that it's going to be a really small business. Maybe you can go into a few more details there, and what you do to sort of to identify those type of opportunities.
Right. So, yeah, it's important to set the context on this. So when we talk about small businesses, we're not talking about startups. We're not talking about a guy who's got some venture capital and he's trying to grow it into the next big IPO. These are businesses that are managed by the owner managed. They are businesses that the owner is relying on that for his income and his family, supporting his family. And they're the businesses and they never hope to raise a dollar of outside capital, right? So they're the businesses you see on every street front. So it's gas stations, it's grocery stores, it's convenience stores, it's pizza restaurants, it's barber shops, it's anything you see driving down any street. What is common to all these businesses, and the average loans are sized to the size of those businesses. So a big loan for us would be $500,000. Average loan on our business side business loan would be about $150,000. And businesses that we lend to tend to have annual revenues less than $10 million. So kind of the 1 to 10 million is really where we're operating. So these are smallish businesses. What we like about them and you've seen that is there's no competition, or very little competition, to provide credit to these people, because the banks won't touch them. For the most part, they won't touch them. And so from our perspective, we have businesses that have very low loss rates. So the loss rates in small business tend to be kind of 2 to 3%, which is typically which is low relative to the cost of the loans, which tends to be 15 to 20%. So there's a lot of room in there for investors to do well. And the banks don't lend to these businesses because they're small, and banks prefer big loans rather than small loans. But they also lack traditional bankable collateral. If you think of the typical collateral that a bank would like to see, banks love mortgages, right? So if you own your premises, you can get mortgage financing, and that can help fund your business. If you have significant fixed assets in your business, you can get credit against those assets, whether it's vehicles or computers or things like that, where you can either lease them or get asset-based financing. Because again, a lender will look at that and say, that equipment's worth 50 cents on the dollar if I have to auction it off when you go bankrupt. So that's how they come up with the amount of money they're going to lend you. Or they look at your working capital and they say, well, listen, you've got good book of receivables there, and I can finance those receivables. These are businesses which tend to operate in cash or credit. So business, you walk in, you pay with your credit card or you pay with cash. They don't have receivables. So again, that takes away that source of working capital financing. So those are the types of businesses we're working with. And what I've just described is most of the businesses you're going to see when you drive down any street in Toronto or Canada or the United States. What these do have, though, which is very important, is they have cash flow, and they have observable cash flow, and they tend to be profitable, successful businesses. They just don't have that collateral. So we're able to make good loans and get paid quite a bit for them and have very low losses.
What are they typically borrowing the money for? Is there a consistent reason, or is it really...
It does vary. It does vary, but it's typically for growth reasons. it depends on the type of business, but it's often, say a gas station that wants to add a car wash or a convenience store to bolt onto it. It would be a restaurant that wants to refurbish or add a patio, things like that. So they need $100,000 to do something, and it's not going to be $100,000 a fixed asset. So how do they get that money? It's occasionally a professional service practitioner buying out a competitor, or buying out a retiring practitioner's book. It's occasionally someone who has one franchise outlet who wants to acquire a second or third franchise. So we'll see. We're in the U.S., but so I use Tim Hortons as a Canadian example. You've got one Tim Hortons franchise, you want to get another one. Well, you use the cash flow of the first one to finance setting up the second one, and you pay that loan off, and then maybe you do that again. So we see that quite a bit. What we don't tend to do, and we do see some that are strictly working capital. So we do a fair bit of IT job shops, so people that are staffing companies. And a growing staffing company consumes capital because your customers don't pay you as quickly as you would like to get paid, and your workers demand to get paid every week. So you're consuming capital. You could be successful in growing, but you're going to be consuming capital. So we do quite a bit of those as well. So those are the types of businesses. Use of proceeds. What we tend not to do is and this is where we're a little bit like a bank, we tend not to lend to people who really need the money. So if you're a situation where you need $100,000 to keep the lights on or to make payroll, we're probably not the lender for that. There are people who you would go to for that, but it's not us.
How do you identify that?
We're primal.
How much data do you get when you're assessing the loan opportunity?
Sure. So it varies by type of loans, but we've been talking about the business loans, so I'll focus on that for a minute. On the business loans, we get the full underwriting file, and particularly with the lender we work with a number of lenders, but the one we work with most closely is a company called Biz2 Credit in New York, and they get a very comprehensive file, if you will. They're getting we're going to see all that. We see this all online, so we get presented with minimum of 6 months of bank statements. We get the PDF copies of the bank statements, but we also get machine readable versions of the bank statements, which we download directly from the bank, from the financial institution. Again, there's open banking companies out there and services out there that provide this. We'll get their tax returns. We'll also get their IRS transcript, which is, in Canadian parlance, equivalent to giving someone your notice of assessment and logging into your CRA account and downloading all that. So we get that. We'll get a site visit of the actual business. So they will send someone out to the business to take pictures and to take notes about the business. Is it open? What are the posted hours? Are there employees here? Are there customers here? Is there inventory on the shelves? And we see photos of the business. If it's a restaurant, we'll see photos of the kitchen. We'll see photos of the dining area. And so you get a sense of, not is this the best restaurant in the world, but is this a business that looks like the business that's described in the loan application. So you get a good sense that way. We'll get ID for the owners, and that's important because all the loans are guaranteed by the owners personally. So we'll look through to their personal credit. We'll get their personal credit report from 2 or 3 different credit bureaus. Once we have their personal credit report, we'll understand what their mortgage balance is if they have a mortgage. Most of the ones we lend to would, because they're homeowners, but they still have a mortgage. So once we know what their mortgage is, we have their home address. We go onto a site like Zillow, which many people are familiar with. It tells us what their house is worth within a few percent, and then we can get a sense of how much equity is in their home, and so that gives us some comfort with the strength of their personal guarantee that they're providing to the loan. So we'll get criminal record checks. We'll get litigation checks. So have they been involved in litigation? Are they currently involved in litigation? All those things. We get it's very robust. and I'm losing my breath, but we're going through all this. And we don't. And this is all done for us, right? So it gets presented to us in an online portal. So we're looking at it on our computer screens. And we don't necessarily need to read every document and go through every document line by line for a $100,000 loan. But what we're doing, because the underwriter's already done that, what we're doing is we're checking to make sure The underwriter has done the job to the standard that we would expect, so they did what they said they were going to do. Did the underwriter miss anything obvious? And sometimes that happens. So we might say, listen, we had one where a guy was at a tow truck towing company, and he was looking for a loan to do something with his trucks. Quick Google of the guy, it revealed he'd previously had a conviction for grand theft auto. So probably not the guy we want to get by a tow truck for. So these things happen. So we do check those. And we check the bank statements for anomalies like gambling, luxury goods purchases, things like that. We've seen one where a guy was spending all weekend making $500 payments to DraftKings because they're gambling. He was gambling all weekend. So things like that. So moral hazard issues we're able to pick up, and then you can make a decision. And again, we're doing that not to re-underwrite the loans, but to catch those outlier issues. Also to make sure the loan fits in our portfolio. So sometimes while we provide our criteria to the lender, say this is the box where we'll look at loans, they don't always know where we are at in terms of our concentration limits. So maybe we're full up on gas stations, and it might be a perfectly good gas station loan, but we already have enough gas stations, or we already have enough Illinois today. So we're going to turn off Illinois.
That's a perfect segue into your risk management. So I was going to ask you, you're diversified geographically, and it's really a micro focus from the lending perspective. Can you talk about your risk management overall between the strategies, and do you care about macro events? Do you care right now about inflation, interest rates going up, or is it really just fundamental?
Yeah, we do. We do. So we're not a macro strat. Like if we think about macro indicators more from a tactical perspective than a overall strategic overlay. That being said, things like inflation and interest rate hikes are an issue. Things like a potential economic recession or slowdown is also an issue, although we haven't seen it yet in the United States. But it's something we're cognizant of. And I'll talk a little bit about some of these. So on the inflation and interest rate things, they obviously they go hand in hand. That's hurting consumers right now. So the consumer finance portion of our flagship fund has not performed as well as we would normally like it to. So that fund is a couple points year to date. It's below its target. We expect it'll return to target performance early in the new year, but it's going to be below its range, which is the target is 7 to 8. It's probably going to come in closer to 5 this year. So and that's largely driven by consumers, which are largely driven by the inflation and interest rate hikes. Even though our loans are fixed rate, people would have floating rate exposure in other parts of their personal portfolio, and that's affecting people. On the business side and on the mortgage side, it hasn't been as affected for a couple of reasons, largely because these are higher cost loans to begin with. And in the case of the mortgage loans, they're project based, and the cost of financing tends to be a relatively small component of the overall project economics in terms of what the developer is looking for in terms of his return on equity. So if a mortgage loan goes from 10 to 12%, which is kind of where we're lending, that's not the end of the world for a mortgage. That's not make or break for most of the projects we're involved with. On the small business side, it's similar. Those loans have kind of gone from kind of 15 to 20. And you say, well, that's expensive. That's expensive money. It is. But if you've got a business plan that already supports paying 15% on a project, going to 20 is only a 30% increase. Whereas if you were to compare that to a consumer mortgage where you were borrowing at 2 and now that's at 6 or something like that, that's a much more severe change. And that's going to have so that's kind of why we're seeing the impact on the consumer side and less on the business side. On the overall economic scene, we do look at that too. Employment is one of the big drivers for us, and kind of we get comfortable if people will still have jobs for the most part, although inflation hurts is a countermeasure to that. But we do look at employment, and we've taken somewhat of a defensive posture generally. So our portfolio duration is about 16 months in both funds. So going through the pandemic, we basically did a complete turnover of the entire portfolio, and we did fairly well through COVID. And we looked at our portfolio as we came out of the pandemic, and we said, well, how do we feel about this portfolio looking forward into a potential recession? And keep in mind, our time frame for this, because it's a short portfolio duration, is what do we think about the next 18 to 24 months? That's kind of our timeline. So what do we think about? And we said, well, we might have a recession, but everyone keeps waiting for one, and it hasn't happened yet. But it might. And we looked at our portfolio. We said, well, by definition, everyone in our portfolio as we came out of the pandemic was a COVID survivor. These are businesses that did well and individuals that did well during COVID, and particularly on the business side. And what do we like about them? Well, those were the grocery stores, those were the gas stations, those were surprisingly liquor stores did well in the pandemic.
Not surprising.
And there were home renovation contractors did well. So the guys that have their business name on the side of their pickup truck, we did a lot of those types of loans to those kinds of guys. There was a lot in that portfolio that came through COVID that we thought would do well in a potential recession. Although we have made some tweaks. So we're still with the takeout restaurants, the grocery stores, the gas stations, and the liquor stores, and things like that. We have lightened up on anything to do with transportation, or where fuel cost is a major input, because fuel prices, they're up and down all the time, but they're generally up right now. So we're staying away from fuel costs, or anything where fuel is a major input. We're staying away from white tablecloth restaurants, because people are going to start cutting back on that. We're staying away from travel and tourism for the same reason. And one of the sectors that did very well for us during the pandemic, the guys with the names on the side of their pickup trucks, we are off of that now, because we think, quite frankly, the home renovation is going to take a...
Okay, so you can really assess the landscape, and you can quickly adjust the portfolio to where you want it to be focused. Okay.
Yeah, it's short duration. So while we're not trading in and out of positions, because there's loans are maturing every day, we're able to shape the portfolio over time, using that 12 to 18 month horizon.
Well, I'm going to stop there. Colin, thank you very much for your time. You've been a great addition to our portfolio. Full disclosure, we are invested in private credit trust and have some exposure to business credit. We've been very happy, very transparent, and it's been a good journey so far. So thanks again, and until next time.
Thanks, Phil. Have a great day.